Hey world, it's Bean. Want to come back to another video. Family, I want to come back to this video. Shout out to all the family members in the garden. Hit me up this morning, and asked me, Bean, why is the stock market going up? Because remember, family, when this whole ordeal started, the market was at almost like 29,000 points, right? People were doing really, really well. I mean, people had 401ks, was pretty happy, okay? And then, of course, it dropped to like 18,000 points. That's over 11,000 point drop, right? So imagine the amount of money that people have lost in their 401ks, in their stocks, Because remember I told you, you've been in the garden a while, I told you a long time ago that this market is overvalued and that it's only being propped up by phony money. And so you have to understand that, but you can only understand it if you know two things. And these two things is monetary policy and fiscal policy, and how that actually works and how that actually affects us economically as consumers, how it affects us economically as investors. See, remember, we always going to be outside of this party that they've been having since the 1800s in regards to this nation being bankrupt and the corporations pretty much, being the contractors and we're the subcontractors. And of course, the government, is the basic main corporation over the contractors and the subcontractors. And so when you know that, then there's only a certain level that you're going to get to if you was never ever invited to the party. The stock market yesterday it was up 550 something points. Then today it's down 500 and something points. So this type of volatility tells you that it's just a bubble. And you have to ask yourself, just to answer the question to the family member about why is it going up? Why did it go from 18,000 to 23,000? Well, because of the monetary and fiscal policies that the Federal Reserve and the U.S. Treasury are doing. It doesn't do anything to benefit us. Remember, we're just subcontractors. We're just workers. But as investors, you can really benefit from this type of shenanigans when you understand the two things that these particular policies, how they affect the economy. Let's look at the monetary policy. Monetary policy, family, deals with the U.S. Treasury. Deals with Federal Reserve. Okay, let me repeat that. Monetary policy deals with the Federal Reserve. And why is that? Because the Federal Reserve is able to just print money at will. They got the printing press. And so when you're able to just print money at will, you pretty much can dictate interest rates in the economy. You can dictate how much money is in the economy, how much money is flowing in the economy, and how much money is taken out of the economy. Because remember, the Federal Reserve is a central bank. And every major developed country in the world have a central bank. They dictate the interest rates about consumption. They dictate the interest rates when it comes to credit and debt. Well, there's something called the LIBOR, the LIBOR. Now, that is a London bank that pretty much decides all the world's rates. Now, you got to ask yourself, how is it that the LIBOR, which is the London's rate, how is it that London, England, pretty much dictates the international rate of borrowing and what banks give? If you know your history, you know why. All right? So I digress. Like I said, the Federal Reserve dictates that. And they try to call it these big words like quantitative easing and quantitative tightening. And all that is quantitative easing is just printing a lot more money and putting it into the economy. Which, do we get that money? No. They give it by printing millions and millions of dollars, and they buy the U.S. debt. Now think about this. How can you buy debt with phony money? Okay? If the U.S. Treasury has $50 to $60 billion worth of debt, in the form of U.S. Treasury bills, U.S. Treasury notes, U.S. Treasury bonds, and the Federal Reserve says, I'm going to print $50 billion and buy that debt, well, the U.S. government is in debt to the Federal Reserve over phony money. And remember, when the Federal Reserve buys this debt, the U.S. Treasury have to pay the U.S. Treasury have to pay that money back with interest. Now, what does the U.S. Treasury do with all this money? They give it to corporations in the form of loans and whatnot. And what does the corporations do? They buy back their own stock. And so when you see that we're in a national pandemic and the government has shut down the whole nation, well, we know that it makes sense, or at least it would make sense, that the Dow Jones, that the stock market would plummet because people are not working. You got 17 million people out of work. You have just last week 6.6 million people applying for unemployment. So we know that when there's a big drop, okay, it's expected, right? But then all of a sudden there's a 5,000 point increase. You're like, hey, how does that happen? When we know that the nation's been shut down. So we know it's not us that are buying these stocks that are just propping up this market, right? It's the corporations. And the U.S. Treasury is working with the Federal Reserve, because remember, when they say they want to get this economy back to work, and when they say they want to keep this economy from crashing, basically what they're saying is they want to protect the U.S. citizens from being so conscious of the fact that they're over their retirement, their 401ks, that they're the ones that's dictating these highs and lows. If you knew about monetary policy and you knew that the Federal Reserve telling you that they're going to inject $2.3 trillion in the market, as an investor, you'd be like, okay, well, cool. That means the market is going to be kind of safer now. But as a smart investor, you say, oh, wait a minute, that's phony. And you're going to wait till this bubble crash. Because if it got to 18,000, family, it's going to drop even more. All the analysts, I mean, even people like myself that do the fundamental analysis and the technical analysis, we know that this is phony. Okay? Now let's get to fiscal policy. Family, fiscal policy is what the U.S. Treasury does by collecting our taxes, paying bills, okay, giving money to bail out industries with our money. That's fiscal policy. And so it stands to reason that even the U.S. Treasury, like back in the day when this thing was first set up, you know, people were able to sustain and live a life, you know, of comfort, buying a home and buying cars and sending their kids to college off of one salary, right? You know why? Because the U.S. Treasury made sure that everybody paid the sure amount of taxes, or at least the U.S. Treasury to make sure that Congress made sure of that, because the Congress made the laws back then, and they make the laws today. So you got to ask yourself, what happened to Congress? Why did Congress all of a sudden start bailing out the rich, all of a sudden start bailing out corporations, all of a sudden pass or allow the president to pass a tax bill that would cut the tax rate of the rich by 60, 70%? Because remember, fiscal policy is when the U.S. Treasury collects our taxes and corporation taxes and taxes from overseas and put it in a pot and make sure that the government, that the country can sustain. Okay? That's the whole notion of this whole U.S. revolution when they wanted their independence from England. Remember, no taxation without representation? So understanding monetary policy and fiscal policy, you will have an idea of why we get, bent over so much. Because you don't understand it. I mean, all the taxes we pay, you don't understand it as a nation when the president and Congress can come out and tell you that they give billions of dollars to other countries in the name of America, right? And we got people over here hungry. We got veterans over here homeless. We have hundreds of thousands of people homeless. We have women in abusive shelters. We have kids that can't go to college. We have debt out of this world. But we're giving billions of dollars to other countries. That's cognitive dissonance, family. That's not understanding how this thing works. So when you understand fiscal policy, that's the U.S. Treasury telling you that they're going to take your tax money and give it to somebody else. That's the U.S. Treasury telling you, according to fiscal policy, we're only going to give you guys $1,200 of the billions of dollars and trillions of dollars that we collect in taxes. That's monetary policy telling you the Federal Reserve run this thing. The Federal Reserve run this thing, and they've been running it since 1913. You think it's an accident? They call Reaganomics. In 1980, Reagan, they say Reagan because remember, these cats are all figureheads. Presidents don't do nothing. A president can't do nothing without agreement from the legislative branch and the judicial branch. It's called checks and balances. It's called separation of powers. It's called limited power. It's called federalism. It's called, I would say popular sovereignty, because that's one of the 7 principles of government. But guess what? Popular sovereignty means they taking the population's vote into consideration. Republicanism means they taking us in consideration. Doesn't happen, family. So when you understand monetary policy, when you understand fiscal policy, then you know that if you don't pay yourself first and be smart about this team,